In this video, I'll talk about the journal entries to purchase and sell inventory using both the gross and the net methods. Also, we will also calculate a cash discount. Before the journal entries, let's review a little math. In merchandising, there's two kinds of discounts that are often confused. The trade discount is a quantity discount. So if you're a customer that does big volumes of business, you're going to get a discount over somebody who's a small retailer. So we're not going to talk about trade discounts. That's common sense based on quantity. We're going to talk about the cash discount. Now there's a common code that's called a cash discount code, and it's read 210 net 30. This means you get a 2% discount if you pay your invoice within 10 days. Well, in business, you should be paying your bills once a week, and if you pay your bills every 7 days, you will always qualify for this discount, and you would just presume that you would take it. Everybody takes it. It's smart to take this discount. Otherwise, pay the net amount, which means the total amount, in 30 days. That's how you read the code. So here's an invoice, partial invoice. Up at the top, we have two terms, the 210 net 30 and then FOB in Sonata. What does FOB mean? Well, I have a separate video on that. Let's focus on the term 210 net 30. You get a 2% discount if you pay within 10 days. Otherwise, you have to pay the net amount of $10,000 in 30 days. It's historically been very standard to give 30 days for people to pay their bills. Now, the question is, how do you subtract 2%? I've got two formulas there. The first formula is the high school way. My students, if they can get it, they always do it this way. You take 10,000 minus 10,000 times 2%. Now that takes a lot more keystrokes when typing into your calculator. So the genius way is to just take your calculator and take 10,000 times 0.98. You get the same answer, but with fewer steps. Most people pay within the discount period because if you get a 2% discount by paying within 10 days, that means you're paying 20 days earlier than you have to pay. So you're given 30 days to pay, but you're paying within 10, so you're paying 20 days earlier than you have to. Well, that equates to 36% APR. So it would make sense to borrow money, use a credit card, borrow at high interest even, and pay your bills on time to get that APR, 36% savings. Everybody who knows the math pays their invoices and takes advantage of that 2% discount, even if you have to borrow money to pay this bill. Okay, next I'm going to show you the journal entries for purchasing inventory using the gross and the net method. On the left, we have the gross method. On the right, we have the net method. The journal entry is the same for both methods, except the numbers are different. When we buy inventory, we're going to debit inventory and credit accounts payable. In the gross method, we're going to use the total amount of the invoice, 10,000. But in the net method, we're going to use the after discount number in the journal entry because we're probably going to end up paying cash of $9,800 because smart people always take those discounts. But it doesn't matter how you set it up. You can set it up either way. if in the first method, in the gross method, if you later pay $9,800, then you have to adjust the inventory account for $200. I'll walk you through and show you. But either way, the results are going to be, in the end, the same. Okay, the gross method. If we pay within the discount period, we will debit accounts payable and credit cash. How much cash will we pay? Well, it's within the discount period, so we only have to pay $9,800. Don't forget to debit accounts payable for the $10,000 because that's what you previously established as the account balance. So we have to debit accounts payable for $10,000, credit cash for $9,800, and we plug the difference of $200 to inventory. In the net method, we were already anticipating taking the discount. So we just debited accounts payable for $9,800 and we credited cash. I'm going to show you next what it will look like if we pay after the 10 days. And what will happen is the net method will require an adjustment and the gross method will not. Okay, 10 days have passed. We're late. We still have 30 days, but we missed the discount period. In the gross method, it looked like you were anticipating paying late, it looks like, and you just debit accounts payable and credit cash for $10,000. But in the net method, in the beginning, you anticipated paying only $9,800. You anticipated taking the discount, but since you're late after 10 days, then you have to debit accounts payable for the balance that you previously established, $9,800. But now you have to pay more than that. You have to credit cash for $10,000, and you have to plug the difference, $200, as an adjustment to the inventory account. Okay, let's look at those same journal entries or those same transactions from the perspective of the seller this time instead of the perspective of the buyer. In the gross method, the seller debits accounts receivable for $10,000. In the net method, the seller debits accounts receivable for $9,800 and anticipates that the customer will only be paying the discounted amount. If the customer pays within the 10 days, in the gross method, the seller will be receiving $9,800 to settle the accounts receivable balance of $10,000. So in the gross method, we will debit cash for $9,800. We will credit accounts receivable for $10,000 to cancel the balance we previously established. The journal entry doesn't balance, so we need a debit of $200, and that will be an adjustment to the sales account. Now, in the net method, it's real easy. You just debit cash for $9,800, and that's the amount of cash you were anticipating. We credit accounts receivable for $9,800, and that account is settled to zero balance. Okay, what if the customer pays after 10 days? Well, in the gross method, this is easy because the seller hasn't recorded any discount yet, and so just receives the cash of $10,000 and will credit the accounts receivable for $10,000. But in the net method, the seller was anticipating that the customer would be paying only $9,800 and established an account receivable of $9,800. But the customer didn't take this discount and ended up having to pay $10,000. So the seller debits cash for $10,000, credits accounts receivable for the $9,800, which was the amount established as the account receivable. The journal entry doesn't balance, so we have to plug $200 to the credit side, and that will be an adjustment of the sales account. There you go.